Hey everyone, and welcome back to another Stoxcompare explainer. Today, we're setting up what I honestly like to call the ultimate financial crime scene. We are looking at a $5.14 trillion giant whose underlying business is just absolutely firing on all cylinders. And yet its stock chart, well, it's seemingly flatlining. It's this massive mystery that is completely baffling retail investors and Wall Street veterans alike. So let's dive right in and figure this out.
Section 1. The Nvidia Stagnation Paradox.
Okay, so here is the disconnect in a nutshell. We're looking at a pretty sluggish 12.58% year-to-date return and a 57.70% one-year return. Now, don't get me wrong, if you're a legacy utility company, those numbers are an absolute dream. But for the undisputed king of artificial intelligence chips, it's completely at odds with the explosive momentum you would naturally expect from a generational market leader.
So I really want you to ponder this question with me for a second. Why on earth is the AI king lagging behind? I want you to think of this explainer kind of like a detective story. We've got our victim, which is the stock's momentum, and we have a literal mountain of evidence to sift through. We're going to uncover the truth behind the ticker and figure out exactly what is weighing this giant down.
Section 2. The semiconductor problem.
It gets even weirder when you contrast Nvidia's sluggish stock performance with the rest of the semiconductor industry. They are honestly being left behind the broader silicon rally. Just look at the massive outperformance of cyclical peers like AMD, SanDisk, and Micron over this exact same period. I mean, they're riding the exact same AI tailwinds, right? Yet their stocks are practically in orbit, while Nvidia is basically grounded on the launchpad.
Section 3. The Revenue and Cash Juggernaut.
Now, here is where the plot completely thickens because the fundamental data tells a drastically different story. We aren't just looking at an earnings beat here, we are looking at a total revenue rocket ship. They made a massive leap from $22.103 billion in Q1 of 2024 to an unbelievable $81.615 billion by Q2 of 2026. That is a 269.2% acceleration in revenue. The underlying business isn't slowing down at all. It's accelerating at a pace that literally breaks traditional financial models. $81.615 billion. And guys, that is quarterly revenue, not annual, quarterly. It is so crucial to anchor the sheer velocity of this growth in your mind because it makes the stock's sluggish 12.58% year-to-date return seem, well, mathematically impossible.
And the hits literally just keep coming. $48.587 billion. That is their free cash flow for Q2 2026 alone. This proves beyond a shadow of a doubt that Nvidia is a real, tangible cash machine. They aren't just posting paper profits based on clever accounting tricks. They are generating absolute rivers of actual cash.
Section 4. A masterclass in margins.
Because they aren't just growing bigger, They are becoming ruthlessly efficient. Net income absolutely rocketed from $12.285 billion in Q1 2024 to over $58.321 billion in Q2 2026. But the real star of the show for me is that 71.46% net margin. I mean, for a hardware-centric company to achieve software-like margins of over 70% is practically unprecedented in modern economic history. The efficiency jump here is just mind-bending. Back in Q1 of 2024, the net margin was already an incredible 55.58%, but by Q2 2026, they squeezed that all the way up to 71.46%. And then there's the EBITDA margin, expanding to an unprecedented 87.0%. To put that into perspective, for every new dollar walking in the door, Nvidia keeps 87 cents as essentially operating profit. It's practically a legal money printer.
Section 5. Diagnosing the market disconnect. So we've got flawless fundamentals, massive cash flow, and historical margins, yet a totally sluggish stock. There isn't just one simple reason for this disconnect, though. Nvidia is actually fighting against three distinct market forces right now: valuation compression, sector rotation, and priced imperfection. Let's break those down. First up, valuation compression. Nvidia's earnings actually grew so much faster than its stock price that it mathematically forced the stock's price tag down to a highly reasonable 32.56 PE ratio. Second, we have sector rotation. The smart money is currently cashing out of the mega-cap leader to fund cheaper catch-up trades in pure-play memory and storage, like the AMDs and Microns we were talking about earlier. And third, priced-in perfection. After years of flawless execution, Wall Street no longer rewards greatness. It's simply become the baseline expectation.
Section 6. The final Stoxcompare verdict.
Which brings us to the ultimate takeaway for retail investors, this widening value zone. You've got the net income line skyrocketing up to $58.32 billion, acting like a tightly coiled spring against a relatively flat stock price. The underlying intrinsic value of the company has completely decoupled from its current trading range. Fundamentals are pulling up hard while market sentiment is temporarily pushing down. And you know how it goes in the market. Eventually, something has to give.
Which really just leaves us with one final thought. We've seen the unprecedented fundamental growth, the crazy 87% EBITDA margins, and the massive free cash flow. So I have to ask you, does this disconnect make the AI king the ultimate bargain right now? Is Nvidia a screaming buy at a highly rational 32.56 PE? When the market eventually rotates back from perfection fatigue to valuing pure, unadulterated cash generation, where do you want to be? Thanks so much for joining me for this explainer. Keep learning, and I'll see you in the next one.